Alright, so I want to do a quick video to go with this blog post, so I'll make it a vlog now. I want to cover investing in the stock market versus investing in real estate and what really is the best deal. You can look on the internet and find all kinds of information that will tell you stock market is better. And it is, but only in one aspect. Now if you were to take, for the data I have, 1968 you had $20,000, you take that $20,000 and you invest it in the stock market. That's going to make you $380,000. That's $380,000 from your initial investment of 20 put in 1968 today. Great, right? That's a lot of money. That's 1,900% return. Right? So if you were to put that same money in real estate, you would only get 1,100% return. Almost half. So obviously, stocks win. Well, that's not really the case. And if I was to have $20,000 back in 1968 and I wanted to invest it in real estate, I wouldn't buy the entire $20,000 house. I could, but that wouldn't be the wise choice. I would take the $20,000, put it as a down payment, right? 25% down, would have $80,000 of purchasing power and $80,000 of appreciating power. At 1,100%, that's $880,000. We're talking nearly $1 million versus only $380,000. Kind of a no-brainer. Right? We say, well, yeah, but the stock market is liquid, I can diversify, there's less risk. Absolutely true, right? And it gives dividends. Absolutely true. Right? Houses are going to cost you some money. You've got to do repairs, there's going to be upkeep, right? That is absolutely the case. We're going to have to fix some stuff. We're going to lose a little money, we're going to have vacancies. But we're going to take that same $20,000, we're going to put $5,000 down on 4 houses. Those 4 houses are worth $20,000 each. The same $80,000, but now we've reduced our risk. We've got 4 properties appreciating. We have 4 different renters. We have 4 times the work and 4 times the repair costs. But again, we're doubling up, better than doubling up on stock market. How much better off are we going to be? And let's talk about the best part of that. Let's say you were 30 in 1968 and you bought those 4 houses. Right? Well, you're 78 today. You probably don't want to manage them anymore. You're going to have to give them up to property management, but you've been making a monthly return of whatever the valid rent is for your area for 18 years. It's been paid off for 18 years. So someone else actually paid the vast majority of that $80,000 appreciating asset for you, and you've been having a cash cow for just almost 20 years. Right? It absolutely obliterates the stock market. But there is some more work involved in stocks. We can talk about that in another post. Alright, so I wanted to add one thing that we left out. So let's say you bought that house in 1968 for $20,000. It's appreciated 1,100% and it's worth $220,000 today. That's super awesome because that's the median home price in the United States right now, which means it's the easiest to sell if you were to ever get into a tight spot and needed to. It stayed the median home price for probably its entire life. Right, well, let's assume that house rents for $1,000 over the past 18 years, right? It was averaging. It's worth more than that now. It probably wasn't worth that back when you first got cash flow, right? We own 4 of those. That's $1,000 times 4, $4,000 a month, times 12, that's $48,000, times the last 18 years, that's $864,000 it's paid you since someone else paid it off 18 years ago, your renters. That is obviously going to cover any repair costs you had on those properties over the time of ownership, unless something truly bad happened, and then your insurance probably kicked in and covered it, so you're still safe.